The stock exchange is not a place for ordinary investments, as most people imagine. It is a ruthless redistribution machine that demands absolute clarity of thought. Big players never look for a deal. They look for the market's capacity to absorb it. If you think you are playing against other small players, you have already lost the battle before it even began. Your task is to see the structure formed by securities rather than just observing their movement. Price is merely a secondary manifestation of intensity, not its primary cause. We are here to understand how this invisible process of capital absorption takes place.
The market always moves along the path of least resistance, which means seeking available liquidity. When you see a sharp move, it is often the result of paper exhaustion at a certain level. Big money cannot simply press a button and buy 1 million shares, as this would instantly destroy the price. They must accumulate a position over a long period, hiding their true intentions. This accumulation leaves clear footprints, which we will learn to recognize on the chart. The ability to read these footprints separates the speculator from the ordinary spectator who is constantly late.
The chart never lies, but most read it superficially, paying attention only to the candles. True information is hidden in the volume that has passed through each price level. Volume is the real dimension of the effort expended to get the price to that point. Where the effort was maximum, there lies the zone of interest for large participants. These are the places they will defend or use to further build their position. Understanding these zones allows us to stand alongside these players rather than against them. The trader's task is to find the imbalance where the price was temporarily inefficient. It is like a coiled spring that is about to release with great force.
Accumulation occurs when supply meets demand at a level that seems random, but is actually carefully chosen. Once accumulation is finished and all available paper is absorbed, the price explodes. It meets no resistance because everyone who wanted to sell has already done so at the old price. Markets move in cycles, consisting of phases of accumulation, markup, distribution, and markdown. Our task is to identify the beginning of the accumulation or distribution phase. This moment is the least obvious to an outsider and the most saturated for a professional player. Success comes to those who see the pendulum at its lowest point before it has even begun to rise. Surgical entry precision and a total lack of haste are required here.
Big money enters the market not with a single trade, but through a series of smaller, strategically distributed orders. They use so-called icebergs. These are large orders that show only a small fraction of their volume. The market sees only the tip, but beneath the water lies a colossal force of absorption. Every time a portion of the iceberg is executed, it is instantly replaced by a new one, creating the illusion of infinite supply. This allows them to buy the required volume while minimizing the impact on price while it is still low. To detect this hidden activity, we use tools for analyzing vertical volume and the market profile. If the price remains at one level for a long time, while an extraordinarily large volume passes through, it is a clear signal. This means that a large-scale exchange of paper between different groups has occurred at this level. Someone is actively offloading, and someone else is just as actively taking this volume into their possession. This is the zone where big players create their support base for future movement. We must look for precisely those places where the average seller has already exhausted their ability to pressure the price. Instead of believing the price will fall lower, we look at whether the sellers were able to do so when volume was at its maximum. If the price failed to break a key level despite huge sell volumes, it indicates buyer strength. This is called a failure of effort. The market showed strength but produced no result. Our trade should begin exactly at the moment of this failure. An entry into a position should occur only after a level has been successfully tested and confirmed.
This does not mean we wait for the price to bounce a significant distance. We wait for a return to the accumulation zone. If the price returns to the level where there was large volume and demand reappears there, it is an ideal entry. We use this zone as protection because we know that big players will also defend it. This is our guaranteed safety buffer, where risk is minimal.
Price has a memory. It constantly returns to places where many unfilled orders previously existed. We call these places high-value zones because that is where the majority of the market formed their positions. Sometimes the market leaves behind low-value zones, where volume was minimal during a rapid move. This creates liquidity vacuums that are later filled very quickly when the price returns there. Movement through these vacuums is fast and direct, without significant resistance. A professional chart reader always works with the volume profile to identify these critical zones. High-volume nodes show market agreement on value, while low-volume nodes show disagreement. Trades entered in low-volume zones often end with a rapid exit toward the main trend.
We aim to open positions on the edge of a high-volume node, expecting the market to be drawn to the next major zone. It is like planning a route between two large cities, bypassing empty stretches. It is important to distinguish between volume that causes movement and volume that stops it. Volume causing a breakout is a sign of strength and continued inertia. Volume that suddenly appears at the peak of a rapid move often signals distribution. This means big players are beginning to offload their positions, utilizing the enthusiasm of the last buyers. They use the panic of novices as an opportunity for their own quiet exit.
Our understanding of price should not be linear. It should be multi-layered, like a geological map. Each level on the chart has its own history, measured by the amount of paper that changed hands there. If a level was broken on weak volume, it is not a reliable resistance in the future. If, however, the breakout was supported by colossal volume, this level becomes a significant beacon for further actions. We always look for confirmation of strength or weakness by looking at volume.
The average trader often makes the mistake of mixing their operational timeframes. He sees an ideal long-term entry, but tries to manage the position on a 5-minute chart. This leads to premature closing, triggered by minor market noise. Our task is to determine the primary time horizon for analysis and subordinate all smaller movements to it. If we are trading a daily trend, we use the 60-minute chart only to refine the entry point. Most errors stem from a mismatch between ambition and the actual holding period of a position. A large position requires great patience and a willingness to ignore short-term volatility.
Smaller time frames only show exactly how the market accumulates enough strength to execute a larger maneuver. They are not the source of the primary signal, but only a tool for its optimization. We must always remember that there is only one dominant trend. Entry into a position should be as synchronized as possible between two time frames. We identify a strong accumulation structure on the higher chart, for example, the 4-hour. Then we move to the lower chart, looking for the last price failure or a small market sweep. This sweep is often the moment when big players collect the final stops before launching the move. Our entry point should be immediately after this final cleanup. Time spent waiting is just as important as the execution of the trade itself. Do not try to catch the first signs of a reversal before the structure is complete. The market must show for itself that it is ready for the next stage, and we must recognize this without emotional interference. Sometimes the best decision is to do nothing, allowing the price to determine its own fate. This is a manifestation of true professionalism, knowing exactly when to step away. The book that will teach you to read the market between the lines. You can learn hundreds of indicators, but still never understand why the market actually moves. Reminiscences of a Stock Operator by Edwin Lefevre is not just a biography of the legendary Jesse Livermore. It is the Bible of market psychology, and it has remained relevant for over 100 years. Why should this book be on your desk? The Mechanics of Big Money. You will learn how positions are accumulated and distributed, the very concepts we discussed in our training blocks. Crowd Psychology. Discover why fear and greed work exactly the same way in 2025 as they did in the 1920s. The Art of Patience. Livermore will teach you that real money is not made by active trading, but by the ability to wait. The Cost of Error. This is an honest story of triumphs and failures that will protect your capital from reckless decisions. The market never errs. Opinions often do. If you want to stop being a weak hand and start understanding the logic of icebergs and liquidity, you must start with fundamental knowledge. This book will change the way you look at every single move on the chart. The link to the book is under the video.
A professional player always begins planning with their exit, not their entry. A stop order is not an amount we are prepared to lose, but the point where our initial hypothesis collapses. We place a stop not where we feel comfortable, but where the market structure would fundamentally change. If we entered at support, the stop must be placed behind the structure that confirms that support, for example, behind a minimum created during a strong buyback. A stop order should be protected by as much volume as possible that has passed below. If big money invested significant effort to protect a certain level, they will not allow the price to break it easily.
Our stop is placed slightly below this zone, using their protection as our own buffer. If the price breaks this level, it means the initial intent of the big players was destroyed. In such a case, our presence in this trade becomes irrelevant. The goal is not to avoid all losses, but to ensure they are minimal and structurally justified. Losses are part of the cost of doing business, but they should not be the result of reckless decisions. Every trade must have a clearly defined distance to the stop before it is even opened. No excuses. No moving the stop if the market goes against you. We use take profit in places where we expect the next major distribution or strong resistance.
These could be historical highs, where a large number of unfilled sell orders accumulate, or zones where we see volumes suddenly surge without further price progress. As the author of Reminiscences of a Stock Operator noted, you should sell where it feels like the market is ready to rise forever. Liquidity is the lifeblood of the market. Price always moves to where it can be found in the greatest abundance. Rising prices require fuel in the form of sellers' stops placed above current highs. Falling prices seek buyers' stops located below current lows. These clusters of stop orders are true magnets. They attract price to collect the necessary volume. Big players use these clusters to build or offload their positions, ensuring high efficiency. When the price approaches a zone with many stops, a rapid spike up or down often occurs. This is called stop hunting, or clearing the market of weak hands.
We do not fear these moves. We use them to confirm our position or to enter. If the market cleared a level of stops and quickly returned, it is a powerful reversal signal. This indicates that all paper was absorbed and the movement should continue. We must learn to see these liquidity levels on the chart, even if they are not obvious. They are usually previous swings or short-term consolidations where people felt safe. That is where most of the stops that are to become fuel for the movement are placed. Our task is to place our entry slightly below or above this zone to take advantage of this momentum. We do not place a stop where the entire market expects it.
If the market slowly rises to a certain level and then sharply breaks it, it could be a trap. This is done to lure in buyers who think the breakout is real, while simultaneously collecting stops. A true strong breakout move gives no time for reflection. It is fast, decisive, and on large volume. We always question slow, sluggish breakouts that give everyone an opportunity to enter.
Position size management is far more important than finding the perfect entry point. We never open the entire position at once, even if the level seems absolutely perfect. The entry should be divided into several stages so that we can react to the market rather than just hoping. We start with a small pilot position, which serves as a test to verify our hypothesis. If the market confirms our thesis, we gradually add volume. Adding volume should occur only after the price has moved in our direction and confirmed the structure. This reduces overall risk because we are adding to a position that is already profitable.
We use the profit as a buffer for subsequent entries, protecting our initial capital. This contradicts the instinct of novices who double down on losing positions, hoping for a bounce. Position scaling also applies during the exit, allowing us to lock in profits in parts. We take the main portion of the profit at the first significant resistance level, which was our initial target. The rest of the position remains to be held if the trend proves stronger than expected. This allows us to secure a result while leaving the door open for a further large move. The process of entry and exit must be methodical, never impulsive, regardless of news or rumors. We do not allow external noise to influence the pre-planned mechanism of volume management. Our position is the result of cold calculation, and it must be managed by that same calculation until the end. Every change in volume requires a new recalculation of risk for the entire trade.
Success on the stock exchange requires an observation skill that is almost beyond the reach of an ordinary person. It is a constant reading of the market without attachment to personal desires or expectations. We must perceive the chart as a blank slate on which a new story is written every day. Our job is to be the translator of this story, not its active participant. The elegance of trading lies in its simplicity and the repeatability of approaches. Steely discipline is needed to stick to the plan when the market provokes doubt. The market will always try to shake you out of a position, creating the illusion of an imminent reversal.
Success on the stock exchange requires an observation skill that is almost beyond the reach of an ordinary person. It is a constant reading of the market without attachment to personal desires or expectations. We must perceive the chart as a blank slate on which a new story is written every day. You must trust your structure and volume analysis, ignoring these short-term obstacles. If your hypothesis is not destroyed at a structural level, there is no reason for a premature exit. Do not let the market take your hard-earned money through fear. We must develop an intuition based on thousands of hours of observation and analysis. This is not emotional intuition, but a deep knowledge of how the market should look in a certain phase. It allows for the quick identification of anomalies and unusual volume clusters that demand attention. Only when the external noise subsides can we hear the true pulse of the movement. Speculation is about patience. Money is made not by active trading, but by waiting.
The greatest profits come from positions that were opened perfectly and then left for a long time. Our task is to catch the beginning of a large move and allow it to develop. This requires mental resilience to withstand consolidation phases without panicking. Big money is made because most players make mistakes at key moments. They sell at the bottom out of panic and buy at the peak out of greed. A professional player always takes the opposite position, acting against the obvious. This requires rejecting crowd psychology and relying exclusively on one's own clearly defined rules. We are solitary operators who see the game happening behind the scenes.
Do not try to trade every day or every hour. The market does not always offer good opportunities. Sometimes the best place to trade is on the couch, away from the monitor. We wait for the perfect alignment of structural factors, volume, and time. Quality of trades always outweighs their quantity. This is a non-negotiable rule. Trading is a waiting game, where the grand prize goes to the one who can remain calm the longest. We do not try to guess, we react to the confirmation given by the market itself. This allows us to minimize subjectivity and increase objectivity in decision-making. Your capital is your tool, and its preservation must be priority number one. You must constantly record your trades and analyze exactly where a structural error was made. Was the volume confirmed, or did you jump ahead of the market in your desire to open a position? This cold reflection is the only path to the stable improvement of your skills. There is no universal holy grail. There is only continuous adaptation to the changing nature of price. Money is made not on price, but on its movement, the ability to join this flow in time. We learn to see how capital flows between different asset classes and different players. This is a process that requires total mental and physical presence in the game. We strive for excellence in execution, not for a constant search for new indicators or systems.
Stay disciplined, elegant in your movements, and most importantly, patient. This is the only way to take big money from those who play by their emotions. The market is always waiting for weakness, and you must not give it the opportunity to show it. Your mental resilience is your main asset in this complex but sophisticated game.
In the end, the market promises nothing. It owes you nothing,
just as you owe it nothing. It simply exists, like an ocean with no emotions, regret, or compassion. It has no intention to punish or reward you. It only reflects your decisions with mathematical precision. So your main opponent is not the market maker, not the big money, and not even the algorithms. Your main opponent is yourself. Your impatience, your greed, your refusal to accept a loss when the structure is already broken. The one who learns to control themselves automatically learns to control their trading.
Success in trading does not come suddenly. It does not appear after a single lucky entry or a profitable month. It is the result of hundreds of discarded ideas, thousands of hours of observation, and ruthless honesty with yourself. You either become disciplined, or the market will do it for you, but in a much more painful way. Stay a student, even when it seems you already understand everything. It is exactly at that moment the market hits self-confidence the hardest. Write down your thoughts, work with structure, respect volume, protect your capital, and let big moves do the heavy lifting for you.
And remember, we are not here to guess the future. We are here to read what is already written on the chart and act when others hesitate. The quiet, disciplined, and patient always take money from those who rush. If you are ready to accept these rules of the game, the market will stop being chaos and will become a system of opportunities. If not, it will quickly and honestly show you the price of your illusions. The choice, as always, is yours.